This program was first broadcast on Canterbury's access media station, Plains FM, and was made with the assistance of New Zealand On Air.
Welcome to your weekly dose of the Accountology Show. I'm your host and chartered accountant, Nicole Haig, with an insatiable curiosity for uncovering accounting ideas to help businesses grow. I have so many nuggets of gold to share. Are you ready to make your good business great? Let's get stuck right in. Hey, it's your host Nicole Haig and welcome to another episode of the Accountology Show. In accounting news, a regulatory impact statement prepared in 2022 by the Ministry of Business, Immigration and Employment, MB, suggested a tourism levy to $100 per visit could see more than 100,000 international tourists opt to head elsewhere. The levy, in place since 2018, generates about $80 million in funding. Currently, the International Visitor Levy, IVL, is $35 per entry fee. MB, which is pushing the tax to $50, $70 or $100, accepts the high end could see visitor numbers nosedive by between 92,000 and 101,000, reflecting a 2.37% to 2.61% drop on the 2019 numbers. This year's budget has factored in the midpoint increase, $70. MB states it has talked to a wide range of stakeholders in the business community, including industry group Tourism Industry Aotearoa, TIA, which had represented the majority of tourism businesses, including airlines and airports. MB did state that stakeholders had expressed concern about how the fee and levy increases might be perceived and the impact on demand, particularly for the Indian and Chinese tourism markets. The sector has responded with shock. Tourism Industry Aotearoa Chief Executive Rebecca Ingham said TIA was deeply disappointed by the inflated tax, which came while the industry was still recovering from the impacts of the pandemic lockdowns. Are you a business owner struggling with profit, cash flow, or to find balance between work and life? At Nicole Haig & Associates, we want to help business owners just like you reclaim your freedom. Freedom to spend quality time with loved ones, freedom from stress, and freedom from financial burdens. But how do we do it? It's simple. We listen, we understand, and we create bespoke, structured programs tailored to your unique business and personal goals. With the right education, coaching, and expert advice, we'll show you how to increase profits, improve cash flow, and align your business and personal goals. Don't do it alone. Let NH+A be your guide to success. Work smarter, not harder, with our proven accountability methods. Your freedom starts here. Contact us today. In today's episode, we're going to break down the basics of cash flow forecasting. We'll cover what it is, how it works, and why it's an essential tool for every business owner. Whether you're a startup just getting off the ground or a seasoned business veteran, understanding and managing your cash flow can be a game changer. And of course, we'll give you some practical tips on how to stay on top of your cash flow and avoid those dreadful financial surprises. By the end of the episode, you'll have a clear understanding of how to use cash flow forecasting to keep your business on the right track. You'll be equipped with actionable steps to take control of your finances and ensure your business not only survives, but thrives in today's competitive market. Now, I know you might be thinking cash flow forecasting sounds a bit technical and maybe even a little boring. It sounds like a whole lot of spreadsheeting mumbo jumbo, but trust me, it's anything but. So imagine you've got a crystal ball that lets you peek into the future of your business's finances. So that sounds pretty cool, right? Well, that's exactly what effective cash flow forecasting can do for you and your business. So why is cash flow so important? Okay, so picture your business as a car. Cash flow is the fuel that keeps it running smoothly. Without enough fuel, you're going to stall, and nobody wants that. Positive cash flow means you have money left over after covering all your expenses, money that can be reinvested, saved, or used to grow your business. We all know that keeping your cash flow healthy is as essential as your morning coffee. It's the beating heart of any thriving business. With so many external pressures on finances right now, it's more important than ever to keep an eye on the future and the other on those dollar signs. Let's talk about cash flow forecasting. Again, it might sound like something out of a finance textbook, but trust me, this is going to be a game changer. So let's come back to the analogy I used before, the crystal ball of your business. Think of cash flow forecasting as your business's crystal ball giving you a sneak peek into the future of your finances. Imagine knowing exactly when you're going to hit a rough patch or when you'll have extra cash to splash. Sounds pretty powerful, right? So how does this magical process work? And how can it keep your cash flow positive all year round? Buckle up because we're about to dive in. And I've said this many times on the show. We all know that positive cash flow is the beating heart of any successful business. And with so many external pressures on your cash right now, it's important to have one eye on the future. Cash flow forecasting is an incredibly important tool for any business. You don't need to be a large global business to do this. Small and medium-sized businesses should also implement this as best practice. With a better view of your future cash flow position, you can make well-informed decisions about your finances. But how does your cash flow forecasting work, and how does it help you maintain a positive cash flow position throughout the year? Because the reality is you are busy enough as a business owner. Do you really have the time to add this to your to-do list? The question actually becomes, can you afford not to do this as part of your regular business practice? You won't have a sustainable business if you don't have cash in the future. So the cash flow process is all about balancing your income, which is cash inflows, against your expenditure, which is cash outflows. If your cash inflows are greater than the outflows, this is called a positive cash position. In other words, you have cash left over even once you've covered all your costs and paid all your bills, cash that can be reinvested in the business. This can be as simple as exporting your historical data from your cloud-based accounting package such as Xero to Excel, or you can invest in a forecasting app like Float or Fathom or Futurely and use historic cash data to project your cash position forward in time. This helps you see where your cash may be in the future. So by running detailed cash flow forecasts, this means that you can understand your future operational cash flow, helping you spot any cash flow holes, seasonal dips, or predicted months of high expenditure before they become an issue. You can plan your costs and expenditure effectively, allowing you to stick to your planned budgets, manage your costs, and plan for any steep price increases. You can avoid the cash flow issues before they happen, using your forecasts to look ahead, plan, and get tighter control over your cash flow management. And if you require financing, you can identify when the period of financing needs to occur, and you have all the details ready for your bank to sort before this cash flow shortfall becomes a problem. So staying in a positive cash flow position is a challenge in the current economic situation. I get that. When supplier prices and operational costs are fluctuating and revenues are hard to predict, it's difficult to juggle your inflows against your outflows. But a cash flow forecast can help you to get a tighter grip on your cash flow. Setting up detailed forecasts helps you to understand your financial story and puts you back in control of your cash flow. Okay, so again, I repeat the important message that turning a profit is at the heart of running any successful company. But without cash flow, you can't run your day-to-day operations or grow the business. Keeping on top of the financial management of your business can be hard work. It's possible to have a profitable business that is struggling to find the cash flow to pay expenses and fund growth. Likewise, you could have a positive cash flow, but you're not turning a profit, particularly if you're scaling. Without an even and predictable flow of cash into the company or the business, you can't control your overheads, you can't pay your employees, and you can't run your day-to-day operations, let alone think about expanding or growing the business. If you're going to be in control of your financial destiny, it's important to get your head around the important process of cash flow management. So let's look at some of the key things to understand about your finances. So profit is a byproduct of a successful business. As the owner, you want to make profits, but profitability isn't the only goal. A business can easily be profitable, but also be highly unstable in the longer term. What you want is stability and consistent revenues. Cash flow keeps your business alive. Good revenues, which is your income, serve to bring cash into the business. And without cash to cover your operating expenses, you have no means to keep the lights on in the business. So cash really is king. You need to know your cost base and your overheads. The flip side of your cash flow position is your costs, right? So in an ideal world, you want more cash inflows than outflows. So it's important to know your expenses and costs and manage these carefully. You need to be proactive about spending management and easing expenditure. So if you take action that reduces your spending, that is hugely positive for your cash flow position. Choose cheaper suppliers, negotiate better deals, and bring that cost base down. But don't do it at the expense of key operating costs. So what I mean by that is don't cut costs that could cost you later. I know of a business that looked at cutting their costs in 2009. One of their largest operating costs was insurance. So they pulled their policy from the mainstream provider, went to a small insurance company that saved them a lot of money. However, the next thing that happened was the Canterbury earthquakes. The insurance company failed and they lost everything. So be smart when cutting your costs. Drive more revenue through increased sales and marketing activity. So if you can increase your revenues, you also boost your cash flow. So it's important to be proactive in running targeted sales and marketing campaigns to increase your sales. And when business is flying, don't take your foot off the accelerator pedal for marketing. You need to keep this up so when things slow down again, you still have traction. And keep the cash flowing and the profits take care of themselves. If you achieve the ideal cash flow position, the company sits on solid financial foundations. The cash is there for investment and the business can grow. It's that simple. Whether you're new to running a business or you're a seasoned business owner who needs some financial support, cash flow forecasting is critical to your business survival, sustainability, and scalability. So we recommend you review your finances, delve down into your cash flow, and come up with key ways for you to increase your cash income and reduce your cash expenses. It only takes a small few tweaks to achieve a far better cash flow position in your business, helping you maintain that positive cash flow and generate profits. And I know times are tough at the moment, and we're hopefully heading out the other side, but small businesses are particularly vulnerable in tough economic times. When sales are slow, there are still overheads and salaries that need to be sorted. Pre-planning and being proactive can help you weather tight economic periods and allow you to continue to thrive. So make sure you have a clear picture of your payroll and any other planned expenses that will need to be accounted for. If there's even a possibility that there could be a shortfall, it's essential to meet this head on. Whether this means talking to your supplier or creditors to figure out an arrangement or compromising on other business outgoings, you must make a plan to ensure that the business or your staff won't suffer. So don't bury your head in the sand and hope for the best. To minimize the stress of cash flow, here's some tips on how to do this. So invoice early. Send any invoices that you can in advance if possible. Perhaps consider whether you have any regular clients or customers that you could offer a retainer or a similar deal if they book services or make a purchase from you in advance. Make sure you chase those payments. Use this opportunity to chase up any outstanding payments. Strong communication and relationships matter, so talk to clients and chase invoices. Talk to your suppliers. A little honesty can go a long way. They really do appreciate it. Perhaps they could extend a line of credit for you, for your payments to them. In most cases, a good supplier would rather offer a little flexibility to keep an ongoing business relationship with you. Review your inventory. Can you find a cheaper supplier locally to avoid the shipping costs maybe, or discuss alternative products that allow you to reduce expenses? Again, review your costs. It's also a good idea to do a general review of all of your expenses. So business costs can creep up, and it's a great time to make a time to check in on your expenses regularly, no matter what your financial situation. So review your regular payments and subscriptions as well as upcoming costs. There may be travel, functions, purchases, subscriptions, which you can decide on an alternative approach to. And the last one's a little bit scary for some. Talk to the bank or the IRD. If cash flow is tight, make sure you have the conversation early so you have everything in place to see you through. Implement strategies to protect your business for the long term and help alleviate cash flow worries. So we've got some smart strategies to control your cash. Cash flow is confidence. The more you have, the better. So if you try some of these strategies to take control of your cash flow. The first is set up your terms of trade. Provide these to your customers at the outset of each job. Ensure that they are signed off. Terms should include when you expect to be paid and your ability to add interest and or debt collection costs on any outstanding payments. The second is stick to your payment terms. Don't let your customers pay you late. Ensure they are followed up as soon as payment becomes overdue. If there's no response, call them. Use a contracted debt collector for slow payers. So the cost of this will be added to the customer's debt because you've added it to your terms of trade. The fourth is set aside cash for tax payments. Have a separate bank account. Put money aside for GST and income tax so you've got it there as they fall due. Manage your work in progress. Don't let this blow out. So invoice it regularly, reduce the number of jobs you have on hand at any one time, and set budgets for your team to stick to. You should measure your inventory cycle. So measure how long it takes on average to sell each item and reduce obsolete inventory. You're better off converting slow-moving or obsolete inventory back into cash to reinvest in faster selling inventory. The seventh is reduce your inventory on hand. Only hold stock to cover the time it takes between the sale of an item and when you can get delivery of that same item. Okay, the eighth is finance the purchase of fixed assets over terms similar to how long the asset will last before it needs to be replaced. The ninth is set a budget, because for both income and expenditures each year, and you need to stick to it. If a new cost is not in your budget, then you have to find it from somewhere else. And the last is build a war chest of cash. This needs to be separate to your bank account or the tax bank account and be enough to cover at least 1 month of expenses. As Dave Ramsey said, you must gain control over your money or the lack of it will control you forever. Okay, so 6 secrets to getting prompt payment. So if you're struggling with late payments, and about half of small businesses are, let's be realistic, here are some simple tips to try. So invoice without delay. Like I said before, your customer can't pay until you've invoiced them. So make sure you pay or you send your bill promptly. Customers will also be more open to paying when they've just received the goods or services that you've delivered. So cash in on the goodwill. There's no reason to delay. Include all the information. Make sure your invoices are all the right information, including a description of the work or the product, the date it was delivered, any customer requirements such as a purchase order number. Some customers have very specific requirements, so ask that they need to see what they need to see on their invoice and make the due date clear too. Ask for prompt payment. Customers used to get weeks to pay, like the 20th of the month, but that's all changing. More than a third of businesses now request payment within a week. You need to consider doing the same. Starting off at 7 days will help set an expectation of prompt payment. It needs to be easy to pay. Customers will pay faster if they can use their preferred method to hand over their money. So you can use a variety of options like credit cards or PayPal. And chase payments. Like I said before, your job's not done when the invoice goes out the door. You'll need to follow up with the customer to make sure that it's being processed. If the invoice goes past its due date, it's time to make a phone call. Okay, so managing cash flow doesn't have to be a headache. With the right tools and a little planning, you can keep your finances in check and your business thriving. Remember, a positive cash flow isn't just about having extra money. It's about having the freedom to grow, invest, and take your business to new heights. So go ahead, give cash flow forecasting a try. Your future self will thank you for it. And hey, if you need a hand, we're always here to help. Here's to a bright and financially stable future. Okay, so we've got 3 action points from today's session. So the first is set up a reliable cash flow forecasting tool. This can be anything such as Excel and importing the information from Xero to get your historical cash data. Why does it matter? Because the tool will become your financial crystal ball, giving you a clearer picture of your future cash position. By seeing what's ahead, you can plan more effectively and avoid any nasty surprises. You can regularly review and adjust your forecasts. You can schedule a weekly or a monthly check-in to review your cash flow forecasts and adjust them based on any new data or changes in the business environment. You can communicate and collaborate with your team. Involve your team in the cash flow discussion. Make sure everyone understands the importance of cash flow management and encourage them to share insights and concerns. Because remember, if the cash doesn't come in, the employees don't get paid. By taking these actions to heart, you'll be well equipped to keep your cash flow positive business and a thriving business. So let's get to work. And if there's one thing that you should take away from this conversation, one little nugget of gold, prioritize regular cash flow forecasting to keep your business financially healthy. By consistently using cash flow forecasting tools and regularly reviewing your financial data, you can anticipate challenges, make informed decisions, and maintain a positive cash flow. This proactive approach is the key to navigating economic uncertainties and ensuring your business's long-term success. So stay ahead of the game, plan for the future, and keep that cash flow running smoothly. Thanks for joining us on the Accountology Show. If you have enjoyed today's show, you're in luck because we'll be back next week. You'll find past episodes at plainsfm.org.nz and subscribe on Apple Podcasts or Spotify to never miss an episode. We would love it if you would leave a 5-star review and tell a friend or business owner who would benefit from hearing our show. We also love hearing from you, so reach out with any comments or a topic you'd like covered, and even suggestions for whom we should get in the studio next for an interview. You can find us on Facebook, Instagram, LinkedIn, and TikTok. Our handle is NH Plus Associates, that's NHPLUS Associates, or email me, nicole@nh-a.co.nz. But most importantly, thank you for taking the time to listen to the show. Until next time, keep building that business into the empire it absolutely deserves to be.